So good morning, everybody. Thank you for joining us on this 23rd of March, exactly 1 year since we entered the first lockdown. Wow, and here we are. So I'm Natasha. For those of you that don't know me, I'm Director of Hawsons Wealth Management. And today I'm merely here as the warm-up act. We have two guest speakers, our very own Matthew and Bernie as well from Foresight Group, who are hopefully both going to deliver quite an interesting talk on both pensions and tax planning. And to be quite honest, if you have one takeaway from this today, then that's a good job done by the three of us. I'm going to save questions for the end, so after Bernie has spoken. So if you want any questions, by all means pop them in either the chat box or save them for the end, and then we'll answer them at that time. So firstly, I'll hand over to you, Matthew, if you want to bring yourself off mute. I think my presenters may turn the cameras off just while they're talking, just mainly for internet issues, but that's absolutely fine, and then they'll turn them back on when we're doing questions. Okay.
Good morning, everyone. So this morning I'm going to be looking at pensions and the reasons why they're such an efficient way of saving for retirement. The aim is to clear up some of the potential misconceptions people may have, also to give some food for thought around planning for retirement and the options people have when they get to retirement. I hope this gives a positive outlook on pensions and retirement planning. These are some of the areas that I'm going to be covering. So what is a pension? Although there are different types, put simply, a pension is a financial product or instrument for saving for retirement and providing for retirement. And since the introduction of auto-enrolment, many more people are saving into a pension through their employer than ever before. So thinking about living in retirement, this is a study done by Loughborough University. It was developed to help people think about and picture the kind of lifestyle they could have in retirement. These standards show retirement living at 3 different levels and the minimum income required to meet them for couples and single people. So you can see here the 3 different retirement living standards of minimum, moderate and comfortable, and levels of income required, and the definitions that the study has given around being able to live at these standards. So they've looked at typical spending categories and the levels of spending in each, and given a required minimum income to meet that expenditure. This is for a single person, so you can see the categories there of the different household expenditure and the different likely ways of spending money in those categories, and how much you may have if you have a particular level of income. So this is for a single person, and then for a couple. If you would like to look at this in more detail, the information is available on retirementlivingstandards.org.uk. The link is there at the bottom of the slide, but if you'd like that link, please, you can request it at the end of the presentation. And it's retirementlivingstandards.org.uk. So if you have a look at each category and think about where you see yourself and where you would like to see yourself in retirement and which category. As we know, people are on average living longer in retirement, with men expected to live for 21 years and women for 23. This is based on retiring at 65. The state pension age isn't currently until age 67. It has been increased to 67 and will go up to 68. So many people will have aspirations to retire before state pension age. So the income gap between retiring and getting the state pension will need to be filled with your own savings and pension. So it's really important to think about how long your retirement savings will need to last for. You're probably wondering how much you need in a pension to provide a particular level of income. We do use a cash flow forecasting tool with our clients that is tailored to their individual situation. This gives a really good indication of the required savings levels and the pot size needed for them to provide a particular level of income for a particular length of time. But as a rough guide, If you want £20,000 per annum to last you for 20 years, then you would need £400,000 as a pension pot. So the earlier you can start saving, the better. And the later you leave it, the harder it will be to save enough. So as I previously mentioned, state pension age is 67 and rising to 68. The state pension will provide you with some income in retirement to meet your needs. The full state pension annually from April 21 in the new tax year is £9,339.20 or £179.60 per week. To get the full state pension, you'll be required to have 35 years of national insurance contributions. So definitely worth checking to make sure your national insurance record is up to date and checking how many years you'll have and how many years you'll expect to have when you come to retire. So thinking back to those retirement living standards, could you afford to live on £9,339 per year or £179.60 a week and have the retirement living standard that you would like? So moving on to types of pension. In addition to the state pension, and when thinking about saving for retirement, there are two main types of pension. These are defined benefit and defined contribution. And for the purpose of the seminar, I will mainly be discussing defined contribution pensions, but just to be clear, I'll explain a bit about each and the differences. So defined benefit pensions, you may sometimes hear these referred to as final salary pension schemes. These pay a known or guaranteed level of income in retirement, depending on how long you work for the organisation and how much you earned during the time that you worked there. These became very expensive for companies to run and are now mostly only seen in the public sector. For example, NHS pensions, police pensions and teachers' pensions are all types of defined benefit pension that pay a known level of income in retirement. You may be lucky enough to have had a defined benefit pension from a previous employer in times gone by, but as I said, these are increasingly rare and very rarely seen in the private sector now due to the expense of keeping these up and running for companies. So on to the main topic of this seminar, defined contribution pensions. These are the most common type of pension. And if you're part of an employer scheme through auto-enrolment, likely the type of pension that you would have. These type of pensions are best thought of as long-term savings plans, where the amount of money or pension pots you'll have when you retire depends on the amount you pay in during your working life and how well the investment performs. So when you retire, you'll have a pot of money to spend however you like, and we'll be looking a little bit later in the presentation at options for making withdrawals and providing an income. So that's defined contribution pensions. Okay, so we'll have a look at pension contributions into defined contribution pensions. Making contributions is a very tax efficient way of saving. This tax efficiency gives you the potential to save more for less. This example shows the amount of money needed to make a £100 pension contribution for a basic, higher and additional rate taxpayer. A tax rebate is added to a contribution at 20%, with a higher and additional rate taxpayer able to claim their remaining additional tax back through self-assessment. So you can see here, you pay £80 into a pension. For a basic rate taxpayer, you get £20 tax relief and you get £100 paid in. £60 it costs to make a £100 pension contribution for a higher rate taxpayer and just £55 for an additional rate taxpayer. Our pension contributions are tax efficient for employers too, not just for employees. They are an allowable business expense when an employer makes a contribution for an employee. Meaning employers can save on corporation tax for the contributions that they make. So business owners can pay themselves contributions through the company, they would then save corporation tax and boost their own savings, giving a double benefit. It's not just the pension contributions that are tax efficient. Pension plans themselves are very tax efficient too. So not only do you get more paid in, excuse me, the money is able to grow free of any income tax on dividends and any interest received from any other investments, and also free from any capital gains tax on any growth. This gives a higher potential for growth of the pot. As well, 25% of the pot can be withdrawn tax-free from age 55. And you may have heard this referred to as pension tax-free cash or tax-free lump sum. So this example here of saving into a pension versus saving into an ISA really brings to life how tax efficiency can help grow your savings. This is based on a 20% taxpayer. So we can see it's a 10-year example of someone saving £800 a month or £9,600 per annum for 10 years. If you invested this into an ISA, after 10 years, you'd have £96,000 invested. And if you saved it into a pension, because of the tax relief, you'd have £120,000 invested. Now, if you are part of an employer scheme, the employer is making contributions as well on your behalf. This would cost the individual even less investing into the pension compared to the ISA. So following on from the previous slide, this example shows the difference after 10 years of saving at the same level with an average growth rate of 5% per annum. So you can see if you saved into an ISA with 5% growth over 10 years, £9,600 a year, 5% per year average growth, £124,225.82 at the end of the 10-year period. And in a pension, £155,282.28. So substantially more by investing into the pension with the same level of growth and the same level of contribution made by the individual. As I said again, if you are part of an employer scheme and the employer is contributing, it costs the individual even less. So what can a pension invest in, and how can you invest your pension? A pension can invest in any regulated investment. This could be stocks and shares, either through a pooled investment fund or managed portfolio, or for some types of pensions, such as a SIP, you can hold the stocks and shares directly. A pension can invest in commodities or physical assets, such as oil, timber, precious metals, again through funds or directly. Cash is an important asset class. It will form part of any pension portfolio to some degree. It provides liquidity and some certainty and is needed for things like making withdrawals and paying charges. You would want to be aware not to hold too much cash in your pension at one time, as it won't provide the returns needed to give you the growth that would be required in the pension. Commercial property is another permitted investment that perhaps people don't think about as a potential pension asset. Again, you can hold this through a fund which owns a portfolio of commercial property, or there is the potential to own commercial property subject to certain rules directly in a pension. You do need the right type of pension to be able to do this, such as a SIP, but owning a property in a pension can be, for business owners in particular, a very effective way to purchase business premises. There is no CGT on the growth in the value and no tax to pay on rental payments. So something to consider for business owners looking to fund a property purchase. Do think about your pension. So moving on to taking benefits from a pension when you do decide to retire or when you get to age 55. You can start taking benefits from 55 from your own defined contribution pension. However people choose to take their pension, 25% of the fund is tax-free. The remaining 75% will be taxable. Tax-free cash can be taken as a lump sum or used to pay a tax-free income if you don't need the lump sum, and that's something that's definitely worth considering. We'll probably discuss that a little bit later again in the presentation. In 2015, pension freedoms brought in massive changes to the industry. This gave retirees the flexibility to use their defined contribution pensions more or less however they wish. Before, most people would need to buy an annuity, but not anymore. We'll have a little look at some of the different options. There are various options and combinations of options for taking funds or income in retirement. Number one, and probably the most common way we have seen since pension freedoms, is flexible drawdown, taking an income from your pension at any chosen level, paid monthly, quarterly, yearly, or however you wish. You can take small lump sums from your pension, with 25% tax-free and 75% taxable. You can still buy an annuity if you wish, and this might be right for some people. You could even combine an annuity and drawdown. So, for example, purchase an annuity with a portion of your pot to cover essential expenditure, and then with the remaining pot, put it into an income drawdown plan to draw flexible income to cover other expenditure that may not be essential, such as holidays and luxuries and days out and that sort of thing. You can take your whole pot in one go as cash, 25% tax-free and 75% taxable. Be aware that if you do this, you will likely pay too much tax. If this is the only option for you, at least try and plan to perhaps take it over more than one tax year to help mitigate some of the tax liability. And we really don't advocate taking pension pots out all in one go unless it is really a last resort, not only due to the tax situation, but also due to other reasons such as not having a retirement fund and not having the money there to draw down on and spend as income in the future. So there are other benefits to pensions as well. A pension is not included in your estate for inheritance tax purposes. So really, if you've got an IHT liability or you've got a potential inheritance tax liability, then the best thing may be not to spend your pension. You don't have to spend it. You can leave it where it is and leave it unspent and spend other inheritance taxable savings that you might have, such as your ISAs and such as your other cash savings. So if you spend them first and leave your pension till last, you may be able to mitigate some of that inheritance tax. It's worth bearing in mind that is under current rules, and obviously current rules can potentially change, as we know, when the Chancellor does the budget. When you die, you can leave your remaining pension to any nominated beneficiary, and they can also pass it on when they die if there's some left. So your pension doesn't die with you. You can pass it on. If you die before 75, you can pass it all on tax-free. But if you die after 75, then the recipient pays tax at their tax rate. So these are some of the potential pitfalls that people face in retirement and with their pension. Now, these all are things that can be mitigated with careful planning and the right advice. So paying too much tax because you've taken too much income in one tax year, it's best to only take out of the pension what you need to spend at any particular time. A poor investment choice with not enough risk to grow the fund or sustain the income effectively that you want to take, or too much risk and too volatile and potentially not diverse enough, so a poor investment choice. Making unsustainable withdrawals at a level too high for the pot to maintain, so taking too much income out over the course of a year or a period of time, and the investment isn't able to to keep up pace with your withdrawals. All of these things could lead to you running out of money during retirement. So the last slide from me follows on nicely from the previous slide with the pitfalls. The benefits of a financial plan and reasons to seek professional advice. So, number one, clear goals. Discussions with an advisor can really get you thinking about what is important to you and help you set clear goals and objectives. Having a clear goal to plan towards gives you a much better chance of meeting your expectations when planning for retirement and when in retirement. So, an investment strategy. A professional advisor will help you implement the correct investment strategy, and an appropriate investment strategy for you and your needs put in place by a professional gives you the potential to grow your fund and to help it last longer when taking an income. Regular reviews. Regular reviews to check that you're on track to meet your goals. If your circumstances have changed, changes can be made if needed, and you may need to bring down, for instance, your risk or increase your risk due to a change in circumstances, and all those sorts of things can be put in place after a regular review when things come to light. And if those things come to light during a review, they can be acted on and mitigated, and there's far less issues later down the line. Now, product knowledge is a minefield out there. New products are being released all the time, and it's our job to keep well informed and understand how these work so we can keep up to date with them and make sure that we're recommending the best and most appropriate products for our clients. Not all pensions will do what you want them to do. It's worth bearing that in mind. With regards to investment options, not all pensions can have the investments that you may want, and income options in retirement, not all pensions will facilitate the type of income that you want to take. So it's our job to make sure that we know all about the products on the market and the best products to recommend to our clients for their needs. Lastly, and it seems fitting to finish on this one, as we've discussed it quite a bit during the presentation, is tax efficiency. Getting the right advice to help you be more tax efficient, not just with making contributions, but also when taking an income. Being tax efficient can really help you get more from your pension and help it last longer. If you can pay less tax on withdrawals, then you can withdraw less to give you the same amount that you need. An example of this would be to use your tax-free cash for income and only take taxable income up to the nil rate band, so potentially paying no income tax on withdrawals in the early years, putting much less strain on the pot. Thank you very much. There's some regulatory information that we need to give you here and some risk warnings. That's all from me this morning. I'm going to hand over to Bernie, and he's going to discuss with you tax efficient investments. Thank you.
Thank you, Matthew. Natasha, can you hear me okay? Can I just check? Can you hear me?
Yeah.
Fantastic.
All clear, Bernie.
Wonderful. Good morning, everybody, and thank you very much for your time. I've just got to, bear with me a second here. I'm just going to try and share some slides, see how we do. Again, Natasha, I'll ask you to just confirm whether you can see that okay.
Yes.
Wonderful. The technology is being kind to us. Great. Fantastic. Hawsons have very kindly invited me to speak for the next 20 minutes or so about venture capital trusts. I have to say, that is, it was a very interesting presentation, Matthew. Thanks for that. But also very complimentary. There are one or two things that you said in there. Well, as I was listening, I was thinking, oh yeah, actually, that's a really good point because it plays in very well with venture capital trusts. And I think one of the points of this is that hopefully I'll highlight how this is not instead of pensions or instead of ISAs, that venture capital trusts actually can be a really useful complement to those investments rather than in spite or instead of them. And hopefully I'll sort of show you that. And also maybe just kind of allay some fears around venture capital trust. And the name itself sometimes strikes fear in the heart. It sounds very kind of esoteric, dare I say, a little dodgy in my Essex accent. And hopefully, if nothing else, I'll put your mind at rest regarding that. So what I intend to do is give you a brief background on how do they come about, what are they, how do they work, and then we'll look at one or two ideas about how people actually use them day to day, which I hope at least one of those ideas might resonate with everybody on the call. And if we have time, and knowing me, the way I bang on, probably we won't. But if we do, then I'll share a couple of stories about companies that we invest in, just to give you a flavour for that sort of thing as well. Natasha, if I could ask one more request of you, that you give me a 5-minute warning, because I'm probably going to need it. I get a bit carried away when I'm doing these presentations, so do shout out. I won't be offended, and give me that 5-minute warning if you wouldn't mind. So that's it. That's what I'm going to do. In terms of anyone who's sitting on the call going, who is he? Foresight have been around since 1984, which makes us the longest established provider of these types of schemes in the UK. In fact, as you'll find out in a minute, we were around before venture capital trusts were. We were around about 10 years before they came on the scene. So we've been around since sort of day one as far as these type of investments are concerned. We're very large, very well established. And as independent advisors, Hawsons are able to choose from around 50 different VCT providers in the UK. And for reasons that they're probably better to explain than I, they've invited me to be the person to come and talk to you about it today. But I'll let them explain their reasons for that rather than try and conjecture. Right, onwards and upwards. So first of all, really, really exciting slide. This is the health and wealth warning right up front, which basically says these are sophisticated investments in the sense of you don't really want to buy these off the page without getting independent advice. So do speak to Matthew, do speak to Natasha before you do anything as far as VCTs are concerned. They are risk on business. These can go down as well as up. So again, you need to know what you're getting into. So that's what this slide is saying in about 1 million words, and hopefully I've done it in a few less. So there we go. Right, so on to hopefully the more interesting stuff. VCTs were introduced in 1995, and the first thing to say is they were introduced by the UK government. They are government sponsored, they are government backed. You will not get named and shamed for doing a VCT. You will not end up on the front page of the Mail on Sunday or in the Panama Papers for doing a VCT. You can relax. These are absolutely government sponsored. And they were introduced in order to encourage private investors to invest in small UK businesses. And in order to take the risk that's associated with investing in smaller businesses, they gave tax breaks. And why did they do that? They did that because they really wanted private investment in those type of businesses. And I would argue that post-Brexit and arguably coming towards hopefully the end of a pandemic, the UK government absolutely want and need private investors to invest in UK smaller businesses right now, arguably more than they ever have done before, which should be a really, really good thing for VCTs ongoing. Clearly, I'm not in the sort of halls of government, so I can't say for sure, and governments can make strange decisions. But what I would say is that the direction of travel right now seems to be very positive in terms of venture capital trusts. As I've already said, the main aim is to encourage investment into smaller, unquoted UK businesses. I won't go through every qualifying criteria because that would be the 20 minutes, but small can be quite big actually. Can have up to 250 employees, for example. That's just one of the rules. So these can be significant sized businesses, but nevertheless, in the overall universe, they would deemed to be smaller, unquoted UK businesses. So what else do they do? They've got tax benefits. I'll come on to that. They also create jobs. And I think this is another reason why the revenue like them, because you're investing in smaller businesses, which are investing in the local communities, which are providing jobs for people, which are paying taxes, VAT, corporation tax, etc. So it's not a one-way street as far as the government are concerned in terms of tax release. They're arguably getting back more on the swings than they're giving out on the roundabouts. Raised about 600 million last tax year, on track to do roughly the same this year, which might be a bit of a surprise given we spent the entire tax year in a pandemic. But actually, the net inflows have held up very well. And again, when I explain one or two ideas around this, it might kind of sort of shed some light on why that might be, but I'll keep my powder dry on that. VCTs are fully listed on the London Stock Exchange. So in other words, you can look at them on the London Stock Exchange website, and you can trade them on the London Stock Exchange website. A bit like any other share, really. It's what we call a secondary market. So there is liquidity available on VCTs through the London Stock Exchange. And similar to a quoted investment trust, what I mean by that is these are closed-end investments, which is terribly kind of financial services speak. But what I mean by that is a company such as ourselves will say, we are looking to raise X amount of money, £10 million, £5 million, £50 million, whatever it might be, in a tax year. And once it's gone, it's gone. So in other words, it's closed in the sense of once that money is used up, that's it. That's the end of that raise. There is no more, which is different to, if you're familiar with ISAs in funds and OICs and what have you, they just create units. So as they have demand, they create more and more units. They're open-ended, hence OIC stands for open-ended investment company, if you're familiar with those. This is closed in the sense of it's a fixed amount of money. And when I say income focused, it's income tax focused in terms of its benefits, but a lot of VCTs are income focused in the sense that they pay a dividend, which is an income. Okay, so really income tax and income are the areas where if you're looking to do something, this might be something for you. So very quickly, what are the tax benefits? So the first one is 30% income tax relief on any contribution into a VCT up to a maximum of £200,000 per tax year per person. Okay, which is a very generous limit when you compare it to things like pensions and ISAs. 200,000 a year is extraordinarily generous. So put it another way, you could get up to £60,000 income tax relief, i.e. 30% of £200,000. The key is that you must have paid the income tax in that tax year in order to reclaim it. So if you haven't paid 60,000 income tax, there'd be no point doing a £200,000 VCT because you couldn't get your full tax relief. You can only get back income tax that you've paid. So if you'd paid £2,000 income tax in a year and you invested 10,000 into a VCT, you would get an effective rate of 20% relief, not 30%. So hopefully that makes sense. In order to keep the tax benefits, you have to hold the VCT for a minimum hold of 5 years. Okay? If you cash in before the 5-year point, you will have to pay back all your tax benefits. The minimum investment is a Foresight minimum, but it's not untypical of others. 3,000, 5,000 tends to be a typical minimum. I think the point I would say about that is that this isn't the world of the super high net worth. This isn't the world of the super rich. You don't sort of moor your yacht in order to fill in your VCT form. If you want to save £900 worth of income tax and you have £3,000 to spare, then you can do a VCT. So it's within the reach of most people. Dividends, i.e. income, not guaranteed. Some pay them, some don't. But if they do, they are free of all taxes. They are completely tax exempt. You do not have to pay income tax on them. No problem at all. By the way, going back to the first one, the income tax relief, a very important point I forgot to make. That is not just earned income. That is anything that is accessible to income tax. So that includes pension income in retirement. It includes dividend income. It includes rental income, rental yield from investment properties. It includes, well, anyway, it includes anything that income tax relates to. That's a really important point because it broadens out the opportunities to use VCTs. So back to dividends, they're tax exempt. All growth, if there is any, again, it's a risk on investment. All growth is tax exempt, free of all taxes. There is no CGT, capital gains tax deferral, and what I mean by that is if you've already triggered a CGT bill, you can't get that tax back by doing a VCT. There are other investments where you can, but a VCT, venture capital trust, you cannot. Although any growth and any income is free of CGT, you cannot defer any existing already created CGT bills. There is no IHT, inheritance tax exemptions here. It's neutral from an IHT point of view. If you died, then the VCT would form part of your estate like any other investment asset, or unless you've done IHT planning elsewhere. But that's where we are with that. It's completely neutral. And loss relief, which is probably the least attractive sounding tax relief known to man, is not available on a VCT, which basically means if you lose your money, you lose your money, and the government isn't going to give you some of it back in the form of further tax reliefs. Okay, so that's loss relief and you don't get it, so we don't need to worry about that. So that's a real whistle stop through. Right, I'm already halfway through my time and I haven't even got onto the ideas yet, so I can feel that 5-minute warning coming fast. So just a very brief explanation of how a VCT works on this very messy slide. It looks like my sort of goddaughter did it and she's 4. But anyway, you've got your investment on the left-hand side. You give it to us. The VCT is our investment company and we give you shares in our investment company, in our VCT. Within those shares, We've invested in a number of companies, and each VCT will be different. Typically will be between 20 and 40 companies. And those companies will all do lots of different and varied things. The three we've got up there are actually an Indian restaurant, a SIM card producer, and a video equipment rental company, for no particular reason than just to highlight the variety of the type of businesses that can be invested in. But anyway, you will get a part of all of those businesses, and it will be reflected within your share. So you will have one share, but that share will be valued based on a collection of underlying investments. In return, you will get your income tax relief up front, which we've talked about already, and hopefully over time you'll get tax-free dividends as these businesses bring in income and profits, and as these businesses are sold, then that will produce income and hopefully capital growth as well. So that's kind of how it works, and you can hold it for 5 years as a minimum in order for it to be effective, which leads me on to the next bit, the power of recycling. So this is really the idea that if you do a VCT for 5 consecutive tax years, you've basically done a VCT for life. And this is why. So first thing to say about this slide is I'm not a big fan of this because I think it should say year 6, year 11 and year 16, but that's just a personal thing, but there we go. Because technically you've got to hold the VCT for 5 years and a day, which I reckon makes that year 6. But anyway, there you go. So what you do is you invest your VCT in year 1. You get your 30% tax relief, i.e. this year. That's all fine. You hold it for 5 years, and then 5 years and a day, you sell it, which you're absolutely entitled to do because you've now held it for more than 5 years. What you then decide to do is buy another VCT with the proceeds of that sale. That VCT will qualify for 30% income tax relief because it's a new VCT, and you've absolutely satisfied all of the requirements, i.e. you held the first one for 5 years, and at that point you could have done what you like with it. You could hold it, you could sell it, and you do what you like. And you chose to sell it, which is fine. And now you've chosen to buy another one. You can't buy the same VCT, that is a rule, but you can do this. So now what you've done in effect is you've got an additional 30% tax relief on that money that you invested 5 years ago. And I think you're probably way ahead of me here. Now you're going to go to year 10/11, and you're going to do it all over again. And then you're going to do it all over again in year 15/16. Point being is, year 1 goes to year 6. The VCT that you invested in year 2, you recycle it in year 7, and so on and so forth. So fundamentally, once you've done those first 5 years, you just keep recycling them. And in effect, you just keep getting the tax relief over and over again, but you're not having to put new money in. You're now putting in the existing money that you put in those first 5 years. Now, clearly, those VCTs may have gone up or down. You may need to put a bit more in. You may want to take a bit out. And that's where Matthew and Natasha and Hawsons come in, because they'll sit down at your review meeting with you and they'll work out exactly what you need. You know, how much of this do you need to leave in VCT? How much of it do you need to take out? Do you need to top it up? Those sort of things. And that's what they'll help you with. But fundamentally, the key point to this is do a VCT for 5 consecutive tax years. Theoretically, you've done it for life. Okay. Taxation on dividends. So we're into a couple of ideas now. I'll whistle through these. If any of you are business owners, then very well, you might be in a situation where you pay yourself up to the higher rate tax band and then you take dividends. Maybe you pay yourself up to the lower band and then you take dividends. You know, there are various ways that you can do it. But I think there is a perceived wisdom that taking dividends can be an efficient way of taking capital out of a business. And all this is doing is kind of adding to that. This slide's gone a bit wonky on mine. I hope you can see it okay, but, oh, gone ahead one. Right, there we go. It was all going so swimmingly. I can't see all of that slide, so I hope you can. But fundamentally, the column I'm interested in on the table is the one on the right-hand side as you're looking at it. And what this is saying is, this client has decided to invest £50,000 in a VCT, and they've done it by paying themselves an additional dividend. Now, because they paid themselves in salary up to the higher rate tax band, they will attract higher rate dividend tax, which is at 32.5%. They have a small dividend allowance, an annual allowance they can offset. And so they basically end up with a net tax rate of 31% on that dividend they paid themselves. Now, they have a choice. What they could do is they could just pay the tax, just pay the dividend tax, and they'd have £34,400 in their bank account. They could do what they like with it. Or what they could do is they could invest that 50,000 into a VCT. Dividend tax is an allowable offset for tax relief. Therefore, they get tax relief at 30%. Now, it's not quite exact maths, as you can see, But what they would end up with is £49,400 in a VCT. They can't spend it for 5 years, but they've got 49,400 as opposed to 34,400. And providing they don't need the money to spend it, that can be an incredibly efficient way of extracting dividends from a business. But it actually gets better than that, because if you link it into what I told you about recycling, you can see how the two things can work in unison. So in this example, this person is taking 50,000 out of their company, and they're doing that for 5 consecutive tax years. So you see that by the time they've done that, after year 5, they've put £250,000 worth of dividends into VCTs. Now, net of initial charges, and we just made those initial charges up, but net of initial charges, they've got a dividend that's paid at 5%, and that nets down to 2,362. That's net of charges because there's no tax to pay on that. That is a gross dividend, tax-free. They're getting that for 5 years in a row, so they're now receiving £11,812 because each one of those 50,000 VCTs each year has its own dividend. And each year they will also be getting 30% tax relief, i.e. 15,000. So at the end of 5 years, they're in a situation where they put 250,000 in, they've got £11,812 income coming in completely tax-free every year, and they've had a total income tax relief of 75,000. Now here comes the fun bit. In year 6, what they are going to do is they are going to basically recycle the VCT from year 1. And they're going to do that in exactly the way that I described. They'll get the 15,000 tax relief again. They won't get any increase in their income because in effect they're replacing the year 1 with year 6. So it's just a replacement. So the income will stay the same. The dividend will stay the same. But the 50,000 dividend they paid themselves is theirs. It's completely unencumbered because they didn't need it to invest in the VCT because they used the money from the year 1 VCT to do that. So they have just taken £50,000 out of their company completely tax-free, or virtually completely tax-free, by recycling their VCT. So once they've done that first 5 years, in effect, this is a way of drawing virtually gross, if not entirely gross, dividends out of your business on an annual basis, basically for time immemorial. Can be incredibly effective. So that's that. I'm rattling through. So tax-free retirement income. I'm going to ask for my 5-minute warning. How close to my 5-minute warning am I, Natasha?
You've got it.
Right. Okay, fine. Right. So I'm going to do one more idea, which is tax-free retirement income. So Mr. Fraser here has got a pension pot, and this would be the defined contribution type. This would be a SIP or something like that. And as Matthew said, you've got 25% of that available as tax-free cash. And in this particular example, that would be £200,000 because the pension pot's 800,000. So this is kind of building on Matthew's idea. So what we've got here, Mr. Fraser has got 200,000 tax-free cash. That's on the right-hand side. On the left-hand side, he's got his 600,000 pot. And he wants 5% income from that per annum. So that's £30,000. At the current tax rates, he's going to pay approximately £3,630 income tax on that 30,000 income because it will be treated as earned income. So what's that? 26,000 and change is his actual spendable income. What he could do is he could take 12,100 of his tax-free cash and he could invest that into a VCT. That at 30% tax relief, and bear in mind pension income is an allowable offset for VCTs, that would produce £3,630 income tax relief. Spooky coincidence, because that just happens to cover his income tax charge. So in effect now, what he's done by doing his VCT is he's getting no income tax on his earned income. He's getting no income tax on that because he's offset it with his VCT. Okay? Now, each year that he does that, and he's going to do that for the first 5 years, just like we've talked about, each one of those VCTs, we assume, has got a dividend of 5%. Okay? That, therefore, is around about £600 a year, and that is going to add year on year on year. So by the time we get to year 5, his actual net tax-free retirement income is actually £33,000, just over, and not £26,000. So he's moved his net retirement income, his annual spend, up by £7,000 a year, and he's paid absolutely zero income tax for that entire period. In year 6, he's going to do exactly what I said to you before. He's going to take his VCT from year 1, he's going to recycle, and he's going to start all over again. But it can be a really, really efficient way of somebody that is taking money out of their pension in retirement, taking a lot more of it, in effect, tax-free, income tax-free, because you're offsetting that income tax by using a VCT. and relatively modest VCT. So, you know, he'll have put just over £60,000 into VCTs over that 5-year period out of 200,000 tax-free cash. That's around about 30% of his tax-free cash. So you're not using all your tax-free cash by any means, but you're enabling a much higher income and some really good efficiency. I'm going to skip that one because we haven't got time. I'm just going to close with a couple of stories, if that's all right, just to give people a flavour of the companies. Is that all right, Natasha? And then I'll stop.
Yeah, you've got about 1.5 minutes, Bernie.
Okay, 45 seconds. Here we go. So AMT are a company that came out of Sheffield University. This is an idea that came out of Sheffield University. I'm sure a lot of you are familiar with 3D printing. It's a big growing part of the world these days. One of the big drawbacks of 3D printing is that things come out of the printer unfinished. They've got literally rough edges on them. They need to be polished and finished. And that can be a significant part of the time and cost involved in doing 3D printing. This company have basically developed an automated system for doing that in seconds. And this is a company that we've got invested in one of our VCTs, and Hewlett-Packard, HP, have just done a deal with them whereby they will recommend this product every time that HP sell one of their 3D printers. I mean, you can imagine the opportunity there, but exciting stuff. And then this one, my son will be particularly pleased with this. This is really at the moment for people who like playing video games. I'm sure during lockdown, an awful lot of people have been doing that. Not me, I'm far too old, but the younger generation. And in order to get the real immersive, experience and to find the guy who's going to jump out and shoot you from behind or whatever, you need to be wearing headphones, I'm reliably informed. Audio Scene have developed a sound bar whereby the sound locates your ears in the room exactly and only where your ears are and fires the sound directly to your ears. It's like having really, really expensive headphones on, but not having headphones on. And clearly the implication for gaming is absolutely huge, but also for home cinema, Netflix, this sort of thing as well. Obviously the applications are massive. And again, we're really excited about that. So these are the sort of businesses, young, exciting businesses, that hopefully, will do very well going forward. Right, that's me done, I think. I'm going to shut up. Natasha, thank you. And everybody else on the call, thank you for putting up with me. I hope there were 1 or 2 bits there that were of interest, and back to you.
Right, thank you, Bernie. So we've got a couple of questions in. Matthew, if you just want to share your last slide for me, it's just got the contact details for myself and Matthew at Hawsons, as well as the group contact and our landline telephone number. I hope everyone found that really informative. First question I've had is, can we have a copy of the slides? Absolutely. After this, we will email a copy of the slides out, no problem at all. And then the next question, Matthew, I think this is probably for you. I've got, what are the typical admin fees for an ad hoc flexible drawdown for pension pots?
So it really depends on the kind of plan, and there's definitely quite a big spread in the charges that people might pay. For making the withdrawals themselves, I would say there are some pensions that don't charge for the withdrawals. It's all included in the annual management charge. And for some, they do charge, say, an annual fee of £75 or £50 or £150, depending on the plan, for being in drawdown. Now, in terms of an annual management charge for a plan, we see anything from 0.75 up to about 2%. And it's really a discussion with the clients about the type of plan that they need and the type of plan that will meet their objectives, as to the type of plan we would recommend. And we would always look at the charges and discuss those with clients and make sure that they're comfortable with those. But there really is a broad spectrum of charges, and that would be definitely something to discuss in a meeting with an advisor.
Yeah, I've got another one for you here, Matthew, so stay on the line. So we've got a question around lifetime allowance. So obviously, as we're aware, there is a maximum allowance that you're allowed to pay into a pension, for those of you that aren't aware. Anything after that, depending upon how you take it, you may be faced with a 55% or a 25% tax charge. The question here is, in view of this and the lifetime allowance tax risk, would you recommend that younger taxpayers consider putting any retirement savings in excess of auto-enrolment minimum into an ISA?
I think you would have to save an awful lot into a pension to get yourself up to the lifetime allowance. And we saw how efficient a pension could be compared to an ISA. I think it's important, if you can afford to have both, then definitely having an ISA alongside a pension isn't a bad idea, because it provides you with some diversity, and also it might provide you with access to some funds earlier than 55 if you need them, some savings that are shorter term than your pension. But in terms of getting up to the lifetime allowance, I think for most people, saving a regular amount, that isn't going to be a particular worry.
Thank you, Matt. I've got another one here, so stay on again. Do you see any attack on the 25% tax-free cash amount in the future? Oh, this is a question we get a lot, isn't it?
We sincerely hope not, because I think that would be an absolute disaster for pensions if it was. But as we always say with tax rules, anything can happen and anything can change. But in the short term, I definitely don't I say definitely, I don't personally see them touching that at the moment, because from my point of view, they're encouraging people to save into pensions by bringing in auto-enrolment, not discouraging. And I think doing that would really discourage pension savings, which I don't think they're looking to do. They're looking at people being able to sustain themselves better in retirement and not having to rely on the state so much. So I think it would be counterintuitive for them to start spoiling things like tax-free cash.
It's a very good point, Matthew. I think as well with the lifetime allowance, you know, we do a lot of planning with clients, don't we, around this? And generally speaking, if you don't touch your pension, you can manage your lifetime allowance just as well. So, you know, it's all about having conversations, isn't it?
I do, and I think, just going back to the lifetime allowance thing, I think it's something to start looking at when you're getting up close to the lifetime allowance. So,
yep.
You know, if you're getting up close to the, you know, you're a few years from retirement and you maybe at that £1 million level, close to the lifetime allowance, there's things you can do around that time to start mitigating and start bringing down that risk level of going above and over the lifetime allowance at that point.
Most definitely. Right, everybody, I think that I'm all out of questions unless there's any more. I can't see any in the chat box, so we will wrap things up for today. Please, if you want to get in touch with us separately, our details are on the screen. Bernie, thank you for your participation in this webinar. We've been really appreciative of you coming on and helping. So yes, we'll wrap it up and have a good day all.